Right, thanks everybody. We might get started in a minute, and if there are more people on the way, then they can jump in. First off, thanks again for joining. I'm David, as the name tag suggests, and I've also got David Thurmond here.
Hello, everyone.
So I just wanted to start by saying that buying your first home is such a huge step, and it's such a privilege for us to help you all on that journey and be a part of that journey. It's a huge step, as I said, and there's so much involved. So hopefully the webinar tonight helps you feel a little bit more informed and points you in the right direction before taking that first step. So what I'd like to start with is introducing you to our team. So you've met David, Thurmond, and myself. We do also have brokers in the office, Mendula, Carly, and Alston, who are supported by our amazing admin team there in the middle, and our marketing team down the bottom there. And we obviously could not do anything that we do without them. So a huge thank you to the team. As a lot of you would know, we do have our office in Berwick, just on High Street in Berwick. I'm sure a lot of you would have seen that just next to the pub there. But that's a little bit about us. Now, what we're going to discuss tonight, obviously buying your first home and what that means. But in more detail, we're going to cover off on the state of the market. So what's been happening with interest rates, what's been happening with inflation, and of course, what's happening in the property market, the big one that we're all curious about. Once we've gone through that, we're going to go through what's involved with buying your first home, what kind of government grants and concessions are available, the savings that you might require to purchase your first home, your borrowing capacity and what that means. And a big one is actually going to be the importance of a pre-approval. I'm sure a lot of you would have heard of a pre-approval. What does that actually mean? What does it cover? We'll run through all of that and why it's such a key detail when purchasing your first home, especially in today's market. And towards the end, we'll run through a little bit more about how we can help as a mortgage broker. And finally, we'll go through some questions. So I might hand it over to you, David, to run through the state of the market.
Fantastic. Thank you very much. And just like DL said earlier, we are so privileged to be able to help clients buying their first houses. It's not often that you're going to spend $600,000 to $700,000 in your lifetime. So the fact that we get to be part of that and help guide you along the way, we are very appreciative. State of the market, it's very important that when you look to purchase a property, because of the high purchase price, we want to make sure that we're aware of what's going on, because that'll help inform your decisions and let you know if it's the right time for you to purchase. So as David mentioned, we'll talk about inflation. First, that's probably the elephant in the room right now, because it's driving a lot of things around the globe that are directly impacting us. Inflation, if you're not aware, is just the rise in the cost of goods and services. So a very simple example of 10% inflation is if you bought a TV last year or 2 years ago for $2,000, now that TV would be $2,200 because it's increased by 10%. So, and it's not just goods, it's also services. So if you're getting a landscape gardener to come around and do some work for you, or if you're going to the hairdresser, all of the costs, all the things that we pay for have all gone up in cost. Now, how will inflation affect you? Well, it obviously means higher interest rates, and we've seen interest rates increase dramatically over the last year. It also means a higher cost of living, and touched on that just a second ago with a higher cost of goods and services. I won't spend too much time on this slide, but I love charts and graphs, especially lovely line graphs like this one. You can see in the first chart on the left-hand side, the black and red lines trending directly up. And this was from the middle of last year. And that's the sign of inflation coming to its peak. And a lot of things will affect inflation. So the war in Ukraine was a massive contributor to inflation. Floods in Queensland and New South Wales, and they made our veggies suddenly a lot more expensive. So there are some headline factors that cause inflation, things that are kind of one-offs and out of our control. And then there's the underlying inflation in the red, and that's more the overall increase in costs for all the things that we have to purchase in our lives. On the right-hand side, you can see the different areas in which inflation is affecting the most. So you can see transport is at 13.1% increase. And again, this is the middle of last year. So I would imagine that's come down a little bit because petrol prices have eased off a bit. But also housing. So if anyone is in the building industry or is considered building and done their research on how expensive construction is, it's crazy. And it's probably increased by, I'd say, 30 to 40% over the last couple of years. So those are just two of the biggest areas where we've seen the biggest increase in cost. Now, interest rates. You have to be sleeping under a rock to not be aware of the drastic rise in interest rates over the last 12 months. If you can see on this chart, it only shows the last 12 months, and we were at a lovely 2% variable rate for quite a long period of time there coming out of COVID. And then all of a sudden, in May of last year, the Reserve Bank panicked and realized that they were acting a bit late on inflation, and so they started increasing interest rates. And we have had a rate increase every month that the Reserve Bank has been in session since then. And so this is dramatic climb up over the last 10 to 12 months to where we're at now. And you look at this chart and you think, oh my God, where is this going to end? Are we in serious trouble here? But if we take some perspective and we zoom out and we look at this over the last 20 or 30 years, we're here at the very end where we can see the trend line ticking back up to that roughly 4% cash rate. If we look at the last 20 or 30 years, we're not in that bad a shape compared to where we've been for the majority of that period. We haven't seen interest rates like this right now since 2012. But the point is that we did have rates that were higher at one stage, and we all survived and we all managed. So it's just a matter of adjusting because we've had low interest rates for such a long period of time. It's now a little bit of a shock to the system to see them ticking up. The expectation is that we will see interest rates start to decrease. So the market and even the Reserve Bank have come out and said that in late 2024 to early 2025, they're hoping that inflation will be back under control, and they'll need to use decreasing interest rates to stimulate the economy and get things going again. So the whole idea with increasing interest rates is that they break the economy and they stop everyone from spending. And then they put the economy back together again by lowering interest rates and encouraging people to spend. So it's a bit of a crazy system, but that's the method behind it. Now, how will higher rates affect you? The biggest issue that we have right now, especially for first home buyers that are purchasing on their own, it means that you've got reduced borrowing capacity. So a client that last year might have been on $60,000 to $65,000 a year, they could purchase a house for $500,000 to $550,000. That's dramatically reduced now because of these higher rates. And obviously reduced cash flow. If we've got higher interest rates to pay on our mortgage, it means we've got less cash in the bank to spend on fun stuff that we want or to put money into savings. So reduced cash flow is definitely a big issue. Now, the property market. The biggest question that I hear from first home buyers around the property market is when is the right time to buy? Because with the, there are some assumptions that with the interest rates increasing, that the property market will start to drop down. And we've started seeing reports in the press, some very serious and dramatic doom and gloom reports in the press about property prices falling 10, 20, 30%. And so there are a lot of first home buyers standing back saying, well, lucky me, I'm going to purchase and I'm going to save myself 30% on a property. I don't see us getting to that point, and for a couple of reasons that we'll talk about in a second. But the reason why we talk about the property market is to highlight that what you read in the press is there to sell newspapers and to get clicks. And so you need to be really careful with what you read because a lot of this stuff is nonsense and a bit sensationalized. When is the right time to buy? It's when you're ready. When you've got enough savings and it's affordable and it's comfortable and you've got a good savings buffer in place and you find a property that you love, that is the right time to buy. It's very hard to try and time the market because usually by the time you think it's the great time to buy, the market has already started to change. So it's very, very hard to try and time the market. And you can only use hindsight to look back and say, yep, that was the right time to buy. I've done well. But it's really hard to look forward and say, well, I think in June or in July might be the best time to buy. So very, very hard to judge. And here's a good reason why. In the newspapers, you would see that property prices have fallen by 10 to 15% on average across the country. But that's mainly in certain pockets. And if we look at this chart here, this chart was done by realestate.com.au, who owns Mortgage Choice now. So we get all of their data, and what they're showing is that inner city suburbs in the more affluent areas, they have seen the biggest drop in values, whereas the southeast suburbs, where a lot of our clients are purchasing, they've only dropped by 3%. So again, if you're trying to time the market and you listen to the newspapers to try and time the market, you come up with something like this and you think, well, property prices haven't really dropped that much in the area I'm trying to purchase in. So how well can you actually time it? All right, David Laline, I might hand it back over to you and you can discuss the steps to purchase your first house.
Yeah, thank you. I'm really glad that you pointed out that it's about that perspective. Not everywhere has decreased by 10 to 15%, and not everywhere will. And buying when you're ready is such a good piece of advice. I can't tell you how many clients wanted to wait when these interest rates started to rise, and every single rise has put them further and further behind, and they're kicking themselves now. But it's when you're ready. It's when you are ready. So, great piece of advice there. Now, what you need when you're purchasing your first home, there are essentially 5 key details that we need to review or need to consider when we're purchasing. The first one, especially these days, is such a huge benefit, a huge assistant in getting into your first home, the government grants. So what government grants are you eligible for? What's actually out there? Savings. Do you have the sufficient savings required by the bank to purchase your first home? And that could be due to a number of reasons with different purchase price or your borrowing capacity. Which leads into the next point. What actually is your borrowing capacity? What's a good borrowing capacity? And how does that impact your purchase price? And the last 2 are just as important. A clean credit report. This means no late payments on existing debts like a car loan or a credit card. And of course, no defaults. And defaults could come from any number of places. So we'll run through those a little bit later. Last thing that we need when we're purchasing our first home, this is important now more than ever, is a pre-approval. And we'll go into it at more detail, obviously, in a minute, but cannot stress to you how important a pre-approval is now. And that's definitely where we need to start with this journey. So I'll start with the government grants. The grants that are most common these days, well, there are 2. There's a stamp duty and a first home guarantee. But essentially what they do is they are going to reduce the deposit that you need to get into your first home. And obviously that's what we need. We want to get into our first home as quickly as possible and with as minimal output as we can. So that's really what we want to see. On the back end of a lower deposit, we have a lower loan that we need to get into the property. A lower loan means more cash in our pocket, which is fantastic. That's what we all want. A house that doesn't cost us the world. It doesn't mean we have to eat minute noodles to live in that house. And finally, the fees that are associated with purchasing a house. Government grants, some of them will actually help avoid some of the fees that you might incur by purchasing. Stamp duty is one that I mentioned before, and lender's mortgage insurance is a massive, massive fee that you can avoid with some of these government grants. So the first one that we'll talk about is that stamp duty concession. When you're purchasing your first home, you receive a waiver on stamp duty as long as you purchase for $600,000 or less. If you purchase for anything above 600 or anything between 600 and 750, you receive a discount, not a full waiver. There are a couple of conditions with that. If you purchase, you have to move into the property within 12 months. And that 12 months starts from when you take ownership. This is important to keep in mind if you're purchasing from an investor. Now, they might have a tenant in the property who is legally allowed to remain in that property for another 3 months, so you can't move in. If that's the case, you can move in afterwards, but you've only got 9 months left to move in. So that's a really important detail to keep in mind when purchasing. It's rare that you'll purchase from an investor and have that issue, but it's something to keep in mind. The second grant that's really helping our clients right now is the First Home Guarantee. And you would have seen this one quite a lot. This is essentially the government becoming a guarantor for you. Now, a guarantor works in a way that they provide another asset as a security for the bank, and it removes some of the risk that the bank is worried about. So they charge lower fees or remove fees, and they provide a lower interest rate on the mortgage as well. So the First Home Guarantee is the same thing. The government will provide an additional security for the bank, up to 15% of the property's value. The bank's not as worried about the risk that they're taking on, so they don't charge you their lender's mortgage insurance fees. Because technically there's less risk and there's more security, they also offer you a lower rate. So win-win for first home buyers. Again, there are some conditions. The big one is that you need a 5% deposit, 5% of the purchase price, and that 5% must be savings. We'll run through it a little bit later, but you also need to cover the costs associated with the purchase from those savings. And the final condition is that you are an Australian citizen, so not just a permanent resident.
Before we go on to the next one, I think it's important to just point out the cost savings for that first home guarantee. When we talk about a waiver of mortgage insurance, I think it's important for clients to realize that that's going to save you $15,000 to $20,000 in fees that the bank would normally charge you without that government scheme. So it's a fantastic opportunity to save $15,000 to $20,000 and also reduce the amount of savings that you have. It's a great scheme.
It is fantastic. And they've been running that for, 2 years now, a little bit over 2 years, I think. And it's been amazing for our clients. So highly, highly recommend. What we don't recommend is the Home Buyer Fund. It works very similar. You might have heard about this one as well, but rather than the government providing a security for the property, they will actually take ownership in your property. So very similar in the sense that you contribute 5% from your savings as a deposit, but rather than just an additional security for the bank, the government actually provides cash towards the purchase, and then they take ownership in your property to the same value. Not a fan. It's also subject to an annual review, which means if your income reaches their cap, then you're no longer eligible. You have to pay them back. If you don't have sufficient insurance policies, if you haven't maintained the property to their standards, which there's a list of criteria, again, you're not eligible, you have to pay them back. And this could backfire in a few years when these eligibility reviews start to take place. So this isn't one that we recommend.
This scheme here, just to clarify for everyone, this is the Victorian Home Buyer Fund that you've likely heard about on the radio or potentially on TV ads. A lot of first home buyer clients will ask us about this fund, and as soon as they hear that the government is part owner of your home, they immediately say, no, this isn't for us. So as mortgage brokers, we need to educate our clients on what schemes are available. And as Dale's outlined quite perfectly, there is a CUD scheme, the federal scheme, where the government is just a guarantor for your loan. And then there is what we consider, what can we call it, bad? Like it is. It's not the greatest scheme in the world when you're government part owner of your house. Sure. Yeah. A less good scheme, which is a Victorian home buyer scheme. So just be very mindful of the differences between the two. We want the federal scheme.
Okay. Yes. And the final one, which I'm sure all of you have heard about, is the first homeowner grant. And the first homeowner grant is a little bit different to the stamp duty concessions and the first home buyer guarantees, in the sense that it's only available for a brand new property, and it is a cash deposit or a gift, really. The government will give you $10,000 cash towards the purchase. Property has to be brand new or never lived in as a condition. Similar to stamp duty, you have to move in within 12 months, and we're going to go back to that in a second. But you also do just have to be a permanent resident, not a citizen. Now, the property being brand new or never lived in isn't something we're seeing quite a lot of these days, mainly because for the most part, it requires a build. So you could purchase a block of land, sign a contract for a builder to build you a brand new, lovely house, and then you're eligible for the grant. Now, not many people are building right now because of the time that it takes land to settle. Some clients are waiting a year, 2 years, potentially even longer before the land is even ready for the builder to start. It's a long time. In the current climate, we don't know if rates are going to increase to a point where you can no longer afford that purchase, but you've already signed the contract. So it's very, very risky. You could sign up for a contract now, wait 12 to 24 months and no longer be able to afford that contract, and you could lose your deposit. So with rates increasing as they have over the last 10 months, not many people are signing up for new builds. On top of that, as David mentioned, larger economic factors such as increased timber costs, increased wage costs for tradies means that building is actually very, very expensive these days. The prices are very inflated. And so we have seen a few clients sign a contract to build for a set price, for argument's sake, 400,000. But when a bank has valued the property, it's come back low. They think that the client is overpaying, and that can cause all kinds of problems. It's a much lighter discussion with building, but the second type of property that you would be eligible for a first-time owner grant is off the plan, which is similar, but you sign a contract, the builder goes off and does the work, and then you pay them when they're finished. So it sounds great, but again, you have to wait quite a while. Will you be able to afford that property at the time that it's ready, when you have to pay for it, or not? That's the risk that not many clients are taking these days. So we tend to see less of the first-time owner grant these days than we did 2 to 3 years ago. Now, moving into the property within 12 months is something I want to touch on a little bit as well. If you have settled on your block of land, say March, you have to move into the house by next March. You have 12 months to move in, which means that the builder needs to go off and obtain their permits. You need to have found a builder, and then they need to finish the construction with you moving in by March. And there have been some cases where it gets very, very tight, where we get to the 10th or 11th month and the build's not quite finished. Will the clients actually move in time or not? And if they don't, maybe they're not actually eligible for these grants that we've obtained and they have to repay them. So there's quite a lot of risk when we're building. So we're not seeing as much of the first-time owner grant these days.
You hear the word risk quite a bit, and you'll continue to hear it when you start speaking with us directly, because our job as brokers is to try and identify all the potential pitfalls that you might have as a first home buyer. And when we start explaining these risks to first home buyers, they're quickly, they quickly lean towards purchasing an established home because it's a safer option in an environment where there's a lot of fluctuation and a lot of uncertainty with increased interest rates, increased costs like DL mentioned, and borrowing capacity suffering because of it. So because of all that uncertainty, it seems to be that established is a much safer option at this time. Yeah. And as a lot of millennials are impatient, they just want to move in. Who wants to wait 2 years to find out that you've got to wait another year? It just takes so long. That's a bit about the grants. So David, I might pass back to you to talk about the next important detail about purchasing a first home, and that is savings. Yes, fantastic. So when we look at confirming someone's borrowing capacity and looking at what they can afford, the two main things that we focus on, one is savings and the other one is your income and your total borrowing capacity. So we'll tackle savings first. When we look at savings, we are looking at how much savings you need based on your purchase price, because oftentimes we're trying to minimize how much someone needs to put in. And the minimum savings that you need is 5% of the purchase price. So what the bank wants and what the government also wants to qualify for their grants is that clients have a 5% genuine savings deposit. And then they also want you to be able to cover the upfront costs. And we'll talk about upfront costs in a second, but just quickly on genuine savings, because again, you'll hear about this quite a bit when you speak to your mortgage broker or your bank. Genuine savings just identifies any savings that you've personally held in your account for at least 3 months. The idea behind it is that the bank wants to see that you've got the capacity to hold on to money and not spend it. That shows that you've got discipline. If you went to Crown Casino last night and you came home with $50,000, the bank would say, congratulations, well done on that winnings, but hold on to it for 3 months and then we'll classify it as genuine savings, because they want to see that discipline that you can hold on to money and not spend it. So it's really important when we're speaking to first home buyers that we confirm that the savings is actually in their account, not in their mom's account or in dad's account or in a friend's account, or, hey, I've lent someone $10,000 and they're going to pay me back tomorrow. That's great, but that $10,000 has to sit in your account for 3 months. So it's really important that it's in your account 3 months. Now, 5% of the purchase price. For those that are not experts at math, I will do some mathing for you. If your purchase price is $300,000, a 5% deposit is $15,000. And you go down the scale, you can see if a purchase price is $700,000, you're looking at $35,000 as a minimum required deposit for that purchase. Now, the cost to purchase. We're focusing right now on purchases up to $600,000 because we know a purchase up to $600,000, as DL mentioned earlier, you don't have to pay stamp duty. Stamp duty is normally roughly 5.5% to 6% of the purchase price. So a purchase of $600,000, if you weren't a first home buyer and you didn't qualify for the discounts, you'd have to put in about $36,000 just to cover stamp duty, plus your 5% deposit of $30,000. So when you're a first home buyer and you qualify for a full waiver of stamp duty up to $600,000, you see that stamp duty is 0. Settlement fee for the bank is roughly $300,000. Conveyancer, who handles the legal transfer of ownership for this property, is about $1,500. Transfer fees from the Victorian government are about $194, and registration fees as well, also a Victorian government charge. They're about $1,500. So in total, your upfront cost for this $600,000 purchase is $3,500. So if we do some more mathing, we've got 5% of the purchase price and 5% of the purchase price plus the upfront costs on a $600,000 purchase. 5% is $30,000. The upfront cost is $3,500, and we have a total required contribution from the client of $33,500. Now, here is a lovely chart that I've put together this evening that shows you the deposit needed or the contribution needed at the end for each range of purchase. So for $300,000, you'd need a total of $18,500. $600,000, you'd need that $33,500 that I just mentioned. And then you see a massive jump up at $700,000. You now need $63,000 in savings. And that's because your upfront costs have increased, because now you have to pay stamp duty. You've gone over that $600,000 threshold. The government's now still giving you a discount on stamp duty, but you've got to pay a portion of it now. And so that's why your upfront costs have dramatically increased. Now, every client's going to have different amounts of savings, different amounts of income. And so we'll oftentimes be working with the client to try and find that sweet spot in how much they want to purchase for and how much savings they need to have in place. So these discussions are always best off one-on-one, where we've got the client's specific situation in mind, but this should hopefully give you a rough idea. The next really big thing that we need to be concerned about is borrowing capacity. So with borrowing capacity, we're looking at your income, your debts, and your living expenses. If we focus on income first, what we're looking for are the different types of income. We've got PAYG income. So if you're full-time employed or part-time employed, your annual salary, you could be potentially earning overtime, commissions, or bonuses. We treat those separate because banks will look at them differently. With your PAYG income, they will use 100% of it. With your overtime, depending on the type of industry that you're in, they will use between 80 and 100%. With commissions and bonuses, oftentimes we're needing to provide 2 full years of consistency before banks will allow us to use commissions and bonuses. If you stand back and put yourself in the bank's position, if they're going to give someone $600,000, they want to make sure that that income is consistent. It's not just one time that you've had a good sale, or you've got this big bonus because your boss was nice to you, but for the last 5 years you've never received a bonus at all. They want to see consistency to give them a bit more comfort. Self-employed income, we can use the profits in the company. We can use add backs like depreciation and interest that you might be spending or might be claiming back. So we can use Centrelink income as long as the children are under the age of 12. And we can also use maintenance payments. Again, if the children are under the age of 12, then we shouldn't have any issues using that. When we look at debts, we're looking at credit cards. In the last couple of years, buy now, pay later accounts have really come on the scene strongly. So Zip Money, Afterpay, FlexiPay, all those buy now, pay later arrangements. We ultimately have to account for a roughly $3,000 credit limit for each of those accounts. So oftentimes clients are having to close those accounts out before they apply for a loan because they affect your borrowing capacity. They bring your capacity down. Personal loans and car loans are big concerns for us because obviously they come with higher monthly repayments, and the higher monthly cost you have going out, the less affordability you have for your mortgage. HECS and HELP, these used to be quite innocent, quite small debts that we didn't have to worry about back in the day. But now that there is a required repayment based on the income that you earn, HECS and HELP are oftentimes impacting someone's borrowing capacity to a point where, you know, it might reduce your capacity by $50,000 or $100,000. So there's sometimes, depending on the HELP balance or the HECS balance, there's not much that we can do. But if you're close to paying them off, oftentimes it's better that we get it paid off first and then try to recoup the savings over time. And again, this is all unique and case by case. So we'll have a chat with you about your unique position and work out what we need to do. Also, maintenance payments. If you are making maintenance payments or child support payments, then we need to take that into account against your, or treat it as a liability, basically. Living expenses. The banks are really, really keen on identifying people's living expenses and specifically those discretionary expenses. Now, some of these banks don't worry too much about, but other banks will treat them differently and worry about them. So childcare costs, private health insurance, private school fees, ongoing medical treatment like orthodontics and chiro. I've got 2 kids that are getting orthodontics right now, and my God, it's expensive. So if you've got those ongoing costs, then we need to account for them in your application. Gym memberships also, oftentimes clients are paying $100 to $150 a month for the gym membership, and that will impact borrowing capacity. So if we can try and eliminate some of these discretionary expenses, then that will help in your qualifying. Now, with borrowing capacity, let's go through a quick case study. If we've got someone that's on roughly $80,000, and this is a single purchaser, so they've got $80,000 income, they've got HECS and a credit card, and the living expenses, they've got private health insurance, they've got a gym membership. For this client, the maximum borrowing capacity right now is $375,000. Now that HECS, let's assume that that's a small balance. So if we look at this again and we say, well, let's try and get rid of the HECS and let's close off that credit card. Because with the credit card, even though you don't have a balance, it's the limit that the bank looks at. You might have a credit card for a $5,000 credit limit, but a 0 balance. The bank will say, tomorrow you can go out and spend $5,000. So we're going to account for the worst case that you've got a $5,000 balance. So ideally, we're getting rid of credit cards, we're getting rid of HECS. We're going to leave the private health because oftentimes that's really important to have, but we can try and get rid of that gym membership because maybe we can do without it. Well, now your borrowing capacity is increased by $75,000 just by getting rid of a couple of things. So during our discussion with clients, we're working out how we can try and maximize borrowing capacity by making small tweaks here and there to improve their position. Your credit report is becoming more and more important every day. Being from America, I am used to your life being driven by your credit score. And it wasn't the case when I first moved to Australia in 2005 and I became a broker, and I was shocked. I was like, banks aren't even asking for a credit score. They don't care what your report looks like. Nowadays, they do. Your credit score is super, super important in determining if you're going to get approved or accepted by a bank. New reports now show the conduct across all of your bank accounts, to include your savings accounts, your credit card, car loans, personal loans, every financial account that you have. The banks can now see it in your credit report. And what they're looking for is your conduct, your account conduct. They're looking to see if we've got accounts that are in arrears, late payments, credit cards that are over their limits, court judgments and bankruptcies, because all of those things are smoke. And where there's smoke, there is often fire. And the banks are trying to prevent fire. They don't want to get involved with a client where there might be potential issues, because what their risk assessment tells them is that if someone's got poor history on their credit card, they're more likely to default on their mortgage. So if we've got issues with credit score or your credit report, then we need to either wait until that comes off naturally. And oftentimes these things can stay on your report for 5 years, or we've got to start doing some work to try and get those things removed. And it's not an easy process. Some things we can try and help get removed. There are some things that will stay on there until they run their natural course. So it just depends on how severe the issues are. Now, pre-approval. As DL mentioned earlier, pre-approval is crucial right now because we're in an environment where interest rates are increasing on a monthly basis. And every time interest rates increase, your borrowing capacity decreases. So if you can imagine submitting an application to a bank today where they say your maximum loan is $400,000, and then tomorrow interest rates increase by 1/4 point, your borrowing capacity is then dropped to $375. And then the next month it increases again, the rates increase again, and your borrowing capacity drops further. And that borrowing capacity, or that pre-approval that you had is just dwindling and dwindling down the longer we go. So lenders have a chance to assess your application in full when you get a pre-approval. They get to confirm your borrowing capacity and your savings and your credit score. It's super, super important that we give them that opportunity to do a full review on you and make sure that you're good to go for your borrowing. And then we can pick some lenders that will give you up to 3 months where they lock in your pre-approval, regardless of whether rates go up or down. And of the 40 banks on our panel, there are only about 10 or 15 that actually allow that 3-month grace period while you're pre-approved. So as a broker, we're looking at not just interest rates and fees and features that a bank product might have, but we're trying to take into account if a bank's going to give you 3 months grace on your pre-approval to make sure that it lasts and it gives you time to find a home, even if interest rates might rise. Now, choosing the right lender, I might hand back over to DL to work through how a mortgage broker works and how we help you find the right lender.
Yeah, thank you very much. As I said at the start, pre-approvals for me are the most important part with buying your first home, especially with these rate rises. Cannot stress how important they are enough. So highly, highly recommend choosing the right lender. Now, as a broker, there are several different factors of your application that we need to consider before we know which lender is going to suit you best. And the biggest one, as you could imagine, borrowing capacity and interest rates. How much can you afford with different lenders, and what are they going to charge you to borrow that type of money? Borrowing capacity does differ between lenders. A big part of that is, like David said, some treat overtime differently to others. Some treat payday loans or I'm struggling to find the word now, but buy now, pay later loans as well. And credit cards, they're all treated a little bit differently with other lenders. So some will give you more money than others. And obviously interest rates. What is this loan going to cost you, and where is it going to be the cheapest, tying you with your capacity? The features that come alongside with a loan, there are several more than what this states. Obviously the etc. covers that, but offset and redraw are often the two biggest ones that we speak to clients about. The offset account is something that a lot of clients want but don't necessarily need. And redraw is a big one that comes with every loan, but they do all want that. Very variable loan, I should say. The last one that we touch on is credit policy. Alongside borrowing capacity, every bank has a little bit of a different policy for their credit. Some banks will take 3% genuine savings rather than 5%. Some will look at tenancy history if you're renting right now as genuine savings. So you could win at the Crown Casino $50,000, and as long as you've been paying rent to the level of that genuine savings, the bank's okay. So everyone's a little bit different, and that's really, really important when we're trying to find the bank that suits you best and meets your goal with purchasing the first home for the price and the area that we're looking at. Now, there are a lot of lenders out there. We have about 40 on the panel at the moment, on Mortgage Choices panel right now. It's a lot of different policies. That's a lot of different rates. It's a lot of different borrowing capacities. And this is why a mortgage broker is so important, because we have a look at all of them at the same time. So you don't need to go around to each bank, say, this is my income, this is my cash deposit, what can I afford? They say X, you go to the next one. This is my cash deposit, this is my income, what can I afford? Every time you do that, you receive a hit on your credit report. It comes back to what David mentioned. You don't want a bad credit report. If you have multiple hits or multiple inquiries, your score goes down. Benefit of a broker is we can see all of the policies, all of the interest rates, all of the features with all of the lenders on our panel at the same time without putting a hit on your credit report. So we look at the 40, we figure out of those 40, maybe 4 or 5 are going to suit you best in terms of a low interest rate, and they have decent offers for first home buyers. They offer the grants that we need to use when we're purchasing. And out of those 4 or 5, we think that there are 2 or 3 that might be great, but one that's really going to suit you best. And that's where we apply. We don't apply to every single one of those lenders on our panel. We find the one that is going to be best, and that's where we go. So there is one hit on your credit report. There is certainty that this loan is best for you and it's going to work for you and what you're trying to achieve with this purchase. So I'm biased, but mortgage brokers are pretty important. And that really comes back to our next steps. Everything that we've spoken about tonight is, it changes. So your borrowing capacity will be different to the next person's, your deposit will be different to the next person's. And that's why you really need to speak with a mortgage broker and work out what is best for you, what is going to suit your situation best. And if you're not quite there, what goals and what steps can we put in place to reach that purchase? Once you've met with the mortgage broker and you've created that plan in terms of how much deposit do I need, how many debts do I need to close to make this work, that's when we move forward and we actually go ahead with the plan. And we've got clients that have been working towards their first house for 12 months, some that have come to us with no idea where they stand and they're ready to go and they purchase within a few weeks. Changes all the time, but the most important thing is that you talk to someone, you talk to your mortgage broker, and you find out what's actually possible for you and if it's going to suit what you want to.
I'm glad that you mentioned that. Creating a plan is so important. A lot of clients that we speak to aren't ready to purchase, and they need that 12 to 24 months to build up their income or build up their savings or to pay off debt. So I love speaking to clients regardless of what stage they're at. And if it allows us to then outline, here are the goals that you need to achieve. When you've got a plan, it makes it a lot easier. You've got some direction.
Exactly. And as a broker, some of the most rewarding deals are with those clients that have come to me and said, you know what, this is what I want to do. They're not ready. And then they spend the next 6 to 12 months really knuckling down and increasing their savings and paying down some debt to make sure that they can get into their home. And it just feels so good to see them finally get the keys and really appreciate the hard work that they've put in to get there. So speak to the broker first, know what's going to work and what you need to do to get to that goal and take the steps. So I really hope that this webinar has helped and it's provided a lot of information. I want to run through a couple of questions. We've had some come through throughout the meeting. I haven't quite answered them just yet. So we're going to go through those. And David, I might field this first one to you. If I use a guarantor, am I limited to only their bank, or can I still go with a lender that you recommend?
Yes, you need to use the guarantor's bank. If the guarantor has a home loan in place, then we need to use that same bank for your loan. There is something called a second mortgage that you can apply for. They're only with particular banks, and they're one of the most difficult things that you can try and do. And when we're looking at someone trying to purchase a property where there's a very short time frame that we're trying to meet, and if you don't meet it, there are big consequences. A second mortgage is not something that I would recommend, and it's not even that viable. So I would say that primarily you need to focus on using the lender that your parents are with.
Yeah, and on the back of that, using your parents as a guarantor is exactly the same thing as using the government as a guarantor, provided you're purchasing within that range and you're eligible for the grant, of course. But the government taking the risk rather than your parents. And yes, there are a few banks that don't offer the scheme, but why not put the government in that position rather than your parents if you can? So on top of that, a lot of people want to use their parents or a guarantor to increase their borrowing capacity. So David, can you explain a little bit more about how that actually works?
This is a very, very common question. So there are two types of guarantees. There's a security guarantee where we're just using the equity in mom and dad's home to help us reduce the amount of savings that we have to put in, and also to help us avoid some lenders' mortgage insurance. And then there's another guarantee called a servicing guarantee. And servicing guarantees are where mom and dad come in and use their income to help you afford your loan because you don't have enough income to afford it on your own. And I think it was in about 2015 or 2016 when the federal government did their first review into lending, where that got squashed. So no longer are banks allowed to offer servicing guarantees because of the government's concerns that parents were getting themselves in over their heads because they were trying to help their kids live a lavish lifestyle that they couldn't afford. And I think it was a great decision by the government because even though it is somewhat beneficial for some clients, it sets the wrong precedent. And I'd much rather see a first home buyer buy on their own hard work and off their own bat, than get mom and dad involved with trying to afford the loan. It's just not right.
Yeah, definitely. So if they can provide a little bit of equity to utilize, fantastic, but we don't want them to be liable for the repayments at all. So, big change there. Can my deposit come from a gift? So yes, I'll take that one. The deposit that you have towards the purchase can come from a gift. There are a couple of things to keep in mind. Banks want to see savings. They want to see genuine savings that you've held for 3 months. So if your deposit is coming from a gift, you need to show money held for 3 months. On the back of that, genuine savings requirements and policies change between lenders. So some banks want to see that you have 5% savings if you're borrowing more than 90% of the property's value. Some want to see it if you borrow more than 88% of the property's value. And so different lenders can offer different benefits in that sense. So yes, the deposit can come from a gift, but for the most part, if it's a smaller gift, comparably speaking, needs to be savings, genuine savings. This is a big one, David. Can I purchase at auction?
You can purchase at auction, but we don't recommend that first home buyers purchase at auction, especially if you're trying to put in the minimum required savings. Purchasing at auction, you are buying the property unconditionally. You're buying the property on the spot and you're required to pay a 10% deposit. And then you are hoping that your bank will then approve you so that at settlement, the bank's going to cover you with the loan. That doesn't, just because you've paid your deposit doesn't mean the bank's actually going to approve the loan. So you could be successful at auction, pay your deposit, and then go to get financed and the bank says no. And then you're at risk of then losing your deposit and potentially getting sued for legal fees. So it's not something that we recommend for first home buyers because normally first home buyers are trying to borrow at the absolute top end that they can afford and trying to put in the minimum deposit required. So there's just too much risk involved for a client if they're making that unconditional offer. We want clients to make offers that are subject to finance so that we then have time to go to the bank, get them fully approved by the bank and get the evaluation done before they then pay their deposit and commit themselves unconditionally to that contract.
Yeah. Correct. Absolutely. This is another good one. Do I need a credit card to build my credit score? Really, really common question. David.
Yeah, so in America, you certainly did need to have a credit card to improve your credit score. And it was a crazy, stupid, backward scheme. Thankfully, in Australia, you're not required to have any kind of liability or debt to prove creditworthiness. As soon as you get a mobile phone plan, that creates your credit report. If you've got a utility bill that you're paying for, a gas, electricity bill, a water bill, that will help create a credit report. So you don't have to go out and get a credit card just to create your credit report, or just to create a good score.
Yeah, and we see it so often, but yeah, that's absolutely right. This is a bit of a general question. I'll take this one. Is there a rule of thumb to know what my repayments are going to be? Yes. For every $100,000 that you borrow at a rate of 5%, which is around about where you pay right now, the repayments are $540 per month. So for argument's sake, if you purchased for $500,000, if you needed a loan for $500,000, we're looking at repayments of about $2,700 per month. And it's actually a really good question because a lot of clients try to tie their repayments in with their rent if they're renting. Not always possible. So with that in mind, $540 for every $100,000 that you borrow, does that fit within your budget? When creating a plan to purchase, what happens when you move in? Can you actually afford those repayments with your lifestyle? Really, really good question. Got one here actually from the other side of the guarantors. If we go guarantor for our kids and they miss payments, what are the consequences and can it affect our credit rating? David.
Yes, it definitely can affect your credit rating because you're ultimately tied to their mortgage. So when we do a guarantor loan, we do two separate loans. We do a loan that is 80% of the purchase against the purchase property or the kid's property. And then we do the remaining required loan. Normally it's about 20% that's secured against mom and dad's property. And so mom and dad are basically guaranteeing that smaller loan. And if the repayments are not being made on that loan, then it could definitely impact credit score for the parents. And this gets us to the really important discussion that we need to have with guarantors to make sure that they understand the risks associated with being a guarantor. It's such a rewarding thing. I've got 3 kids and I hopefully don't have to be a guarantor for them, but I would certainly happily do that if they required it. And it's a great thing that parents can do to help out their kids and help them get a leg up. But you need to be aware of the risks. You need to be aware of how long it's likely that you'll need to be a guarantor before they remove you. And you'll need to be aware of, what if the stuff hits the fan? What do we do and how do we fix it? And how do we make the best of a bad situation? So as a mortgage broker, we have an in-depth conversation with the applicants and just as in-depth of a conversation with the guarantors so that everyone's on board and understands what the risks are.
Yeah, correct. And we definitely try, the guarantee is set over 30 years, similar to the mortgage that the clients take out. Ideally, we want that guarantee, removed within 2 to 3 years. And subject to big factors such as what happens with the market, does the property price go up or go down, and how much debt have the clients reduced in that time. But we've had quite a few clients actually, thankfully, hit that goal. They've been able to remove their parents as guarantors within 2 to 3 years, and they then have 20% equity in the property, standing on their own 2 feet. Works really, really well, but it's not something we can rely upon. And as David said, we have to outline that with the guarantors. We could have it for 30 years. And if the clients don't make payments, it could come back to bite you. So yeah, it's just all about informing and discussing those risks. Now, I believe we went through this a little bit in the presentation, but should I wait a bit longer for property prices to drop before I start looking to buy?
I'll take this one if you don't mind. So the issue with waiting longer is that you're potentially waiting for rates to increase further. And every time interest rates rise, your borrowing capacity drops down. So you could well benefit by waiting 6 months. We could have a softer property market and you could save yourself 5 or 10% on the purchase price. And you could also find that in 5 or 6 months, your borrowing capacity is decreased so much that you can't afford that property anymore, regardless of whether it's decreased by 5 or 10%. So it's a little bit of a slippery slope. And it's kind of back to what we were saying earlier, where it's really hard without hindsight to predict when you should purchase. Really hard.
I'm glad you mentioned trying to offset the rate rises, because that's something that I've seen a few clients struggle with. They need a little bit more savings to reach their goal, but then the rate rise knocks them out of the park. Yep. And so for argument's sake, every rate rise that was coming through, they were losing $40,000 to $50,000 worth of borrowing capacity. You can't keep up that level of savings every single month back to back. It just doesn't happen. Yep. So when it's right for you. Yeah, best advice. Bit of a two-parter, actually. It's a big one. Are there any differences between building or buying an existing property, and what costs are associated with owning a property? Differences with building and buying a property. Obvious one is that you have to wait for the build to take place versus the existing property. In terms of grants, the difference comes back to that first homeowner grant that's only available if the property is brand new or built. So you don't get that when buying an existing property. The other big difference is stamp duty. Stamp duty is payable on the value of the property when you buy it. Now, if you're buying an existing property, it's worth a lot more than if you're buying a block of land. So for argument's sake, you can purchase an existing property for $600,000, no stamp duty. You can buy a block of land for $600,000, no stamp duty, and then build on top of that. So that's the difference. You can increase the purchase price when you're building and still be eligible for those first home owner grants and concessions, but you have to wait a lot longer. In waiting a lot longer, you have interest charges on the land loan while you're waiting for your build, interest on the build as it takes place, potentially rent while you're waiting for the build to finish. And you also have the little bits and pieces that you don't get with an existing property. Curtains don't come when you build. Generally, a driveway doesn't. A lot of builders are tying that in now, but generally not. And landscaping. So you could be saving yourself $50,000 to $60,000 by building, but then you lose all of that between interest charges and upgrades to the house that you're building and landscaping and things like that. So pros and cons. And as I said, building is quite risky in terms of the time that we have to wait, what that does to your borrowing capacity, and what happens in the property market if the value goes up or down by the time you're ready to pay for it. And the bank's ready to pay for it. On the back end of that, what's associated with owning a property, what kind of costs? Big ones, council rates is the big one. Roughly, correct me if you think I should adjust this, David, but roughly $1,800 to $2,000 a year for council rates in Casey and Cardinia, around that area. So about $2,000 a year. Utilities, obviously. One thing that also shocks clients a little bit is connection fees. So when they're renting, they'll pay utility charges, the usage charges, but they don't have the connection charge. That is included when you own the property. And roughly $100 for each utility, $100 for gas, $100 for electricity, $100 for water every month on average. Solar panels, water tanks, that all changes things, but roughly $100 each. So they're probably the biggest things to keep in mind. One thing that I also know has hit a lot of clients is the constant need for maintenance or knickknacks. When you buy your first home, you likely don't have enough furniture to fill the whole house. You likely don't have everything where you want it to be, or the color scheme that you want it to be, or the carpet that you want. Houses need maintenance and they need upgrading and updating all the time. And that sets a lot of clients back when they move in. And it comes back to what David mentioned, have a good savings buffer when you purchase a house to do things like that, or to cover increased mortgage costs, because there's always little extras that pop up. You might need a new hot water service within 6 months of moving into the house. Those kind of things can be quite expensive. So hopefully that answers the question. Looks like just one last one for you, David. How long after I pay off a debt can I apply for a mortgage?
Yeah, good question. With existing debt, oftentimes we are submitting pre-approval applications with that debt still open. And we're just mentioning to the bank in the application that the client wants to purchase for $600,000. Once they do purchase, they will then close off their credit card. And what that allows us to do is leave that debt open and not close it off until we know that we need a loan or that we're going to get a loan. So in case the bank knocks us back, you're not wasting your savings paying down a credit card or closing off a credit card unless we know that it actually needs to be closed because we're really close to getting a formal approval. So that's part of the discussion that we'll have in that first meeting to work out, is it a debt that you need to start working on now? Or is it something that can be left open and then closed just before you've purchased?
Yeah, that's one of my favorite things about pre-approvals. It's it's kind of like an I promise bank. If I do this, can I have the money? I promise I'll close my credit card. I promise I will pay off my car loan. And they say yes. And then you've got a bit more time to do that. So yeah, good question. Well, that's just about everything that we had tonight. I haven't seen any more questions come through, so I might leave it there. As I said at the start, hopefully this has provided a lot of information for you and highlighted that there is quite a lot to consider when purchasing your first home, but there is help out there, starting with your mortgage broker. So thank you all for attending. Thank you, David, for all the insight and running through the webinar tonight. I look forward to seeing you all very soon.
Lovely. Thanks, guys.